I always say, always run to the tough market. I'd say especially earlier in your career.
Yeah.
Let me explain to you why that is, and I'll give you an example of
It sounds scary, so you're going to have to break this one down for us.
when you're not comfortable with something, especially when you get that big job. It doesn't need to be a CFO job. Maybe you got promoted to lead your team or whatever. You feel like you've lost the ability to ask the stupid question. False. Ask the question. Ask the question. So everybody want to go to Apple. Everybody want to go to Meta. Everybody want to go to Google. I'm like, what are you doing? Go work at a paper mill. And let me explain why that is. Cost avoidance and cost savings are two very different things, right? Especially when you're in a metrics-intensive, publicly traded environment. And that's another one that people wrestle with. And, I think for finance people, we need to be really careful because cost avoidance is very important.
Yeah, can you say more about that? Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast, where we decode the balance sheet. Sometimes I'm not that great at balance sheets. I'm more of a P&L guy, and the human side of business. Today, we're taking a spin, sometimes literally, through the world of Verra Mobility. If you've ever driven through a toll, rented a car, or gotten a traffic ticket in the mail, like my wife, all the time, you've interacted with their products, whether you knew it or not. Verra Mobility is nearly $900 million in revenue. They're publicly traded, and they operate quietly in the background of our everyday lives on the road. They're the silent infrastructure behind seamless tolling, traffic enforcement, and smart mobility across cities and highways. Joining us is their company's CFO, Craig Conti, who manages product lines with margins ranging from 20% to 65%, which makes for a pretty unique challenge when it comes to financial storytelling and investor expectations. We'll get into how you keep 25-year-old relationships with rental car giants in major cities like New York sharp, and how to build a finance culture where everyone from ops to engineering connects their work to business outcomes. How do you talk to engineers and tell them how much they're worth is work? We'll talk risk, the kind you can see coming and the kind that turns into a very expensive lesson. Plus, what it means to run toward a tough market and why hard skills are now just table stakes for leaders. And of course, the lightning round. We talk about worst expense reports, best advice to your younger self, and the software stacks that keep it all running. All this and much, much more after a short word from our sponsors. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell me your boy CJ sent you. Planful.com/metrics. If you're a CFO trying to keep up with usage-based billing, complex contracts, and a finance team drowning in spreadsheets, listen up. Meet Tabs. Tabs is the AI native platform automating contract to revenue for finance teams that are scaling fast. Whether you're selling custom terms, usage-based pricing, or a mix of PLG and sales-led, been there, Tabs turns month-end chaos into clean cash flow. It's like having a controller that never sleeps and a billing analyst who actually understands your pricing model. No more manual reconciliations, no more late-night close deadlines, just clean data from contract to cash. It used to drive me nuts that we do all the work to close the books inside our ERP in our FP&A tool, and then we had to export the most important part, revenue, to this janky spreadsheet and manually calculate what we did that period. And don't even get me started on the back of the envelope calcs we did to get to ARR based on all the unique contract terms we had floating around. Our investors would wince if they knew. Let's be honest, legacy systems here are not going to cut it, folks. Tabs is the system I wish I had in my CFO days. Fast-growing companies like Cortex, StatSig, Cursor, and others are already using Tabs to instantly generate invoices from any contract, automate RevRec, cash application, and get finance out of manual mode. If you want to automate the mess and fix the way money enters the building, baby, go check out tabs.inc/metrics. Again, that is tabs.inc/metrics. And if your team's still closing the books like it's 2015, now's a good time to upgrade. Craig, welcome to the podcast.
CJ, thanks for having me.
I want to start off by quickly covering the products that Verra Mobility offers, because I was explaining it to my wife the other night at the kitchen table. I was like, oh, I got Craig coming on the podcast tomorrow. And I was going through, and she had a couple of reactions to the products, actually, because we've experienced them in real life.
Yeah, that's I get that a lot. Is how I'm saying. So let me start out. So for the Verra Mobility, global leader in smart mobility technology that makes transportation safer, smarter, and more connected. That's the overarching. So size and scope of the company, we've got, it's about a $900 million revenue company. As of last year, heading into this year, 46% margin, so very profitable company, generates free cash flow as a percentage of that EBITDA number in the 40 to 50% range. So again, it generates a lot of cash. When I think about the size and scope of the business, we're global. We're in 13 different countries around the world, 1,600 employees, 2,400 customers, and we've been public. We just celebrated our 6th year as a NASDAQ publicly traded company. The company actually dates back to the late 1980s. So let me tell you a little bit about what we do. So we're number one in each of our 3 core markets. So our commercial business, we're the number one in toll management for rental cars and fleets in North America. This is a high single-digit organic grower with almost all recurring revenue. And to give you an idea of scale, this is about a $400 million business, and we process over 220 million tolls a year. So to go back to what you were telling your wife, the easiest way to think about this as a consumer is if you've ever rented a car in the United States and you've run a toll, there's a 98% chance you were a Verra Mobility customer and you didn't even know it.
We're a happy paying customer, Craig, in this household. And it's our fault, but I mean,
hey, listen, we appreciate your patronage. That transaction is 100% outsourced to Verra Mobility. We do the same for large corporate fleets and a few other things. Our government solutions business is the number one provider of road safety cameras in the world. We have about 70% of the U.S. market. And what road safety cameras are, these are things like red light cameras, speed cameras, school bus stop arm cameras, bus lane cameras. This is a mid-single digit organic grower year on year, 98% renewal rates, very sticky business. We've opened between $150 and $300 million of TAM in the last 18 months alone. So very rapidly growing business here. And again, I like to, hearing about the business for the first time, what do we do? I like to give a sense of scale, right? So this is a $400 million business. We operate in over 10 countries, by far our most global business, and 11 billion vehicles pass by our cameras annually. And that's not 11 billion events, but 11 billion vehicles, to give you the size and scale. And then finally, our parking business is the number one provider of parking solutions to large universities and medium-sized municipalities in North America. Again, to give you an idea here, this is 2,000 customers. Think of it as the ERP for parking. right? So we don't actually have parking lots, but we do the ERP for parking. This is a high percentage of recurring revenue, all software, 95% renewal rates in this business. And again, on a size and scale, we talked about 2,000 customers in North America alone. We put about $2.5 billion of commerce a year through our systems, and it's about $80 million in revenue. So that's kind of what we do. Final point on size and scale when I think about financially, we just closed 2024. We grew the top and bottom line. So that's revenue, all organic and adjusted EBITDA by 8% on both the top and bottom line. We generated $150 million of free cash flow, and we grew EPS by 14% year over year to $1.23 a share. So great performance by the company. Love the markets we're in. Happy to talk more about it.
That's an amazing overview, and like I'm just struck by the durability of this business, and I'm like shocked that I didn't know about it before. And I think it's because you do such a good job of just being the infrastructure of what we do day to day as citizens of the U.S.
That's right, and that's where we're comfortable. This is a B2B or B2G, business to government on the government side, and we're behind the scenes. But a lot of the customers, one thing I like to say, depends who I'm talking to, but 50% of our revenue comes from 4 customers. Could be a great thing or a bad thing, depending on who you ask, right? But we've had each of those customers 15, 20, 25 years. So when I've been in the role now for over 3 years, but the one thing that continually strikes me about Verra Mobility as an enterprise are the deep customer relationships that we have. And that's really across the board. There's people on my finance team who know people at the customer. There's obviously, we've got the sales and operations team. So to have an enterprise like this that continually grows and has been as successful as we've been, those customer relationships are really, really key. And I think that's the secret sauce of Verra Mobility.
Well, let's talk about that, because I was listening to some earnings calls, and New York City has been a customer for over 20 years, which I thought was amazing. And you've handled tolls for some of the largest rental car companies for more than 25 years. I think that's so cool. Then my mind goes to, wow, how do you continually invest in these relationships and not just like get complacent or rest on past success?
Yeah, CJ, look, that's a great question. And I think anyone looking at the company for the first time needs to ask that. And here's what I'll say is one of the things that we say around here, there are certain things that show up in the company's mission that, you might hear about once a year. This is one of those things that shows up in the company mission that we hear about. If a week goes by and we don't say this, something's up. That is that we serve our customers at the highest point of their need. And what does that mean? So when I heard that as it's hitting your ear for the first time, I was like, well, that kind of sounds good, but I don't understand that. It's exactly what you're talking about. So we treat each of these customers, these are public RFPs on the New York side. And, we do renew these contracts with some kind of every other year, or every 3 or 4 or 5 year regularity on the racks. So there definitely is we're out there facing competition. But even when we're not in a renewal period, we think about this as we need to earn that business every single day. And one of my big jobs around here is capital allocation. And I think as we go on, I'll talk more about that, how I think about that, how I think other people can, maybe benefit from some of the things that I've learned and hopefully use that. But the first dollars out the door are always to core expenditure, whether that's service people, whether that's R&D and capitalized software in our own products. We don't even think about allocating capital to M&A or repurchases or any of those other things that we talk about a lot externally. That conversation doesn't start until every business has what they need to continue to expand our relationship with our existing customers. Every day start and ends there. That's how you do it, CJ.
And it's easier said than done, and I applaud you for always having that at the forefront of everything you do, because it's very easy to say, oh, listen, New York City, they've been around for 20 years, like they're not going anywhere. But if you start to have that mindset, then you have a customer that was integral to what you do, who may not stick around if something better comes up.
For sure. For sure. And we take that very seriously. And I've been in other industries in the past where you had a direct competitor. So for instance, I worked at a company that had it was a welding company. And you look at one other publicly traded company, Lincoln Electric, and there is that rivalry. And that is healthy.
It is.
That tension is very healthy. It makes businesses better, makes both sides better, and the customer wins. Right. And as I look at that for Verra Mobility, obviously we have that from the external environment, but we do it inside our own four walls too. And I think that the sustained focus on making sure that tension is always there has helped us, really have long relationships with the customers that we're really proud of.
Craig, I'm a student of the game when it comes to listening to CFOs describe their business models, because I see it as like an on-ramp. How do you make this easily accessible to people who may not have heard of you before? And you did like a bang-on job of describing what Verra Mobility does. And it's not the easiest thing off the bat because you have so many different business lines. Right. How does that make your job as a CFO more difficult? Because you can't just say, listen, like, I'm just going to take an example. You're a cybersecurity company. We do endpoint detection. It's a 80% gross margin business, 100% recurring revenue. Like, you don't get that walk in the park when you describe your business.
Yeah, that's a really astute observation. And the way I say that is I wouldn't say there's a perfect comp for Verra Mobility. There's probably not even a very good comp for Verra Mobility. And so let me tell you, CJ, how I say it at investor conferences. When I go to an investor conference, if God forbid I'm the first person on stage, by the way, our CEO is much better at talking than I am. So I'm doing my best for you, okay? But if I'm the first one on stage, this is what I say. I said, look, I want to make one thing clear to the audience. I compete for investor dollars, period. So the way you do that is you common size the business. Organic revenue growth is this. And this is how much of it is on a recurring basis. This is what we can do with profit. This is how we generate cash. Now, okay, everybody generates cash. Let me be more specific and say, I can't tell you what's going to happen in 6 months, but I'm going to tell you exactly the filter we're going to put our cash through to make sure that it's deployed to your benefit. And the first thing out the door, I don't even make that decision until we've got what we need or the customer has what they need, right? So it really comes back to, without that perfect comp, it's a blessing and a curse. The blessing is I get to tell the story, right? And I don't have to, nobody else frames my narrative because nobody else does what I do in the same way that we have competition, of course, but not the same way that I do it. It's a bit of a curse because people who don't know the company don't know how to think about you. So you go back and you common size the metrics and say, look, $1 in gets you this at Verra Mobility. I think that stacks up really, really well for other companies of my size.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Hey, metrics fans, let me ask you something. Do you know what keeps CFOs and finance teams up at night? Well, it's not the complex analyses or forecasting models. It's the mind-numbing tasks of chasing receipts, reconciling expenses, and juggling 5 different systems just to track company spending. I was talking with a finance leader last week who calculated her team was spending an astonishing 20 hours weekly just on expense administration. That's nearly 1,000 hours annually on low-value tasks. That's why I'm excited to tell you about Rippling Spend. Rippling Spend is the only platform that automatically handles your entire company's spending in one unified system. What makes it different? It's built on Rippling's workforce platform. So when org changes happen, like someone getting promoted or changing departments, all approval workflows, access permissions, and policies update automatically. Picture this. When your marketing director goes on vacation, expense approvals don't sit in their inbox waiting for their return. Instead, they're automatically routed to the right backup approver. No manual delegation needed. Meanwhile, your finance team gets real-time visibility into all company spending with no more month-end surprises. As a Run the Numbers listener, you can get an exclusive demo showing exactly how much time your org would save. Just visit rippling.com/metrics to learn more. That's rippling.com/metrics. Do it, guys. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on. all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. Pulley.com/mostlymetrics. Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes. The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics. Wow, that's a really good saying. Like $1 in gets you that. And growing up, my dad, when he used to describe something, he'd be like, "What's the size of the bread box here?" That was, I don't know.
Use that one. I use that one.
Oh, you do? I was like, I've never seen a bread box. Maybe that was something.
Yeah, it's bigger than a bread box. That's
bigger than a bread box. Yeah, that's exactly what he used to say.
That's
but Craig,
right.
I love how you went through and you gave me an idea of scale. So I just wanted to call that out because I think there are a lot of people who are aspiring to become CFOs out there, and they're like, how do I orient someone from the outside to my business?
You know what? Let me give a quick tip and trick on that. I talk about this internally a lot. My wife is a software engineer by training, and now she leads a software team. And I have 2 kids in high school, and my father's a retired police officer. I talk to them. They're very smart, but they're not in business. They're not in finance. I'm like, if you can understand what I'm saying to you, I mean, they're all have plenty of mental horsepower to do it. Like, then I know I filled in the gaps. So what I would say to especially financial people is talk to a non-finance person and what you're trying to communicate. You will be amazed the questions you get. You're like, well, wow. If I didn't tell you what EBITDA meant, you might as well stop listening after the first 8th word of my 2 paragraphs I just told you. So once I found that through my career to be really, really helpful. Try it out on somebody who doesn't know what you do for a living. If they can follow you at least 90%, then you're probably on something.
I fell into the exact same thing. I was explaining to my sister, I think that's who it was at Christmas, what my past company did. And we were a marketplace for B2B auto parts. And I got through like the 5-minute explanation. She's like, so who's buying the brake pads?
Yeah. So right there. I mean, you're like, oh man, I got to reel it back in. Yeah.
Well, let's talk about decoding finance for people across the org. You told the quick anecdote there about explaining to your family what you do at Verra Mobility, but in your job as CFO, how do you decode finance for people throughout the organization?
This is critical. This is absolutely critical. I think one thing that's really important is you have to first be able to link operations and finance, and probably in the public CFO chair, you have to be able to link the stuff that you talk about externally, because people listen to your earnings calls, they read your transcripts, right? And say, how does what I do contribute to what you just said? And I tell you, if you can't do that, that's a problem. There's a lot of things I think you can develop in a certain role. The innate ability to do that is one you want to nail before you sit in this chair. well, right? That is really, really important. So let me see if I can answer your question really succinctly. I talk about revenue, cost, and profit. And profit is EBITDA, but I just say it's profit. At the end of the day, everyone can understand those three things. But when you look at a publicly traded company, then you get into things like leverage and EPS. And I'll get, well, how does what I do contribute to EPS? And my answer, if they're not financially inclined folks, I'm like, it does, but don't worry about it. We do more of that at the corporate level. Your metric is revenue, profit, and EBITDA, and here's how that translates. So I think the big thing that you want to do is whether you're talking with a group, you're setting a target, or you're helping run a team, or if you're really lucky, you get to be close and on your hands on the product, right? When you're doing that, make sure that the three key metrics of the business, you can link that activity that person is doing to how it moves those three levers. Here's another example I like to use. I do this one with accountants, but it's, if you walk into your office and turn on the light switch, something just happened. A journal entry was just made. A financial transaction happened. I want you to think like that when you go to talk to an operator, because a lot of times what I've seen in my career that you really, I think, need to drill into as a CFO is operators will do what they believe to be the right thing. Sometimes it's kind of oblique, though, how that maps to the financial performance of the company. Nothing is more dangerous than an operator running with data that is not rooted in the financials of the company. Then you get people doing the right thing, but it has the opposite impact. So those linkages are critical, and always keep it at revenue, cost, and profit. Later for the other complex financial metrics. That's how I do it.
Okay, so let's make it real here. You go in to do like an all hands with the engineering team. Do you cater your delivery to them in a different way that makes it more accessible to what they do?
100%. 100%. And so this is how I think about finance for non-finance people. And it's going to be a little hokey, but bear with me.
Let's do it.
I'm going to try to bring it home.
All
okay?
Right.
And the question is, have you ever watched TV on a Dell computer? TV, Dell. So if you think about TV and Dell as acronyms, I'm like, if you understand TV and Dell, you know everything you need to know about finance. You'll follow me forever. And here's what that means. TV, time value of money. Dell, debt, equity, lease, loan. That's finance. That's it. That's it. And then I'll go through and say time value of money. Here's the example I use there. I've done this with middle school kids, and I'm going to do it with you, CJ. Don't worry, you're going to get it right. I promise. Is if you put $100 into the bank and you went into a savings account and you went a year later, would you have more or less than $100?
I would hope more.
Okay, I would think so. So let's make it real. To your point, at 5% interest, how much would you have after a year?
105.
Perfect. So you know what you need to do to get $105 a year from now, right? So if you can say it's 100, it's going to turn into 105, or it's 105, how much do I have to put in today? Conceptually, you understand the time value of money. That underlies every capital allocation decision. Yeah, I don't care if it's Verra Mobility or Meta or the U.S. government. That's exactly how it works. If you conceptually understand that. Why that's important is $1 today is more valuable than $1 tomorrow. That, I think, really resonates well with engineers, for instance. Then on the Dell side, debt, equity, lease, loan. On debt and equity, I just put up a mortgage. $500,000 house, put 10% down. There's your debt and your equity. Your neighbor builds a house more expensive than yours. Your value goes up. That was equity, not debt. That's it. That's how stocks trade. All right, let's keep going. We're almost done with finance, by the way, right? You can't do this with any other function. Then you get to a lease and a loan. And a loan is, we already talked about that. That's your mortgage. A lease just has the same thing, but at the end of the day, you give the asset back so it has a residual. That's finance. And when I start with that, people start to make connections. So when a question you'll get a lot, I think, in operational finance is, well, this saves money. What do you tell me it's not a good idea because it saves money? The time value of money discussion helps people understand that when the money is saved, not just the fact that it's saved, is more than half the battle here, right? So as I go and have those conversations, I go with those concepts, I put the business in those concepts, and then when I talk about the metrics of the business, I plainly explain what those are. Revenue is money in, right? That's how much we get. Cost is how much we spend. Profits how much we keep. That's all you need. That's all you need. Later, for all the accounting, I have a phenomenally talented accounting and finance team that'll help you through all that. If you understand TV and Dell, you will have enough firepower to ask the right question and make a good frontline financial decision.
That was great. The whole time you're going through this, I'm thinking about an interaction I had with another business leader who ran our data cataloging team. Wonderful guy. Always wanted to come back and tell me how much he had saved on not hiring an incremental person, on not buying a software tool.
For sure.
And I was thankful for it, but I also tried to explain on a couple of occasions the time value of money, that we actually want to invest in the business and grow it. So there's a difference between saving and allocating capital to get a return back on it.
That's right. That's right. And that's a great example. And to be clear, take that example a step further. Cost avoidance and cost savings are two very different things, right? Especially when you're in a metrics intensive, publicly traded environment. And that's another one that people wrestle with. And, I think for finance people, we need to be really careful because cost avoidance is very important.
Yeah. Can you say more about that?
Yeah, sure. So if you avoid spending $1, that doesn't necessarily make you comparatively better year over year or versus somebody's expectation. It's good, but the great thing is if you can save $1 that you're already spending, because the way that financial analysis works is it's always comparative. It's very difficult to look at any number in absentia. There's an old adage that I love for finance is that there's no perfect metric, right? Metrics, or a combination of metrics, only inform you what question you need to ask. They don't give the answer. That's why we will get into does AI ever solve finance? I don't think so, because I there's always that aspect of it. I don't think so. Maybe I could be wrong, but I don't think so. So when you're looking at cost avoidance, very, very important. Always want to be looking at that. But remember that in a public company, or kind of any company, a dollar out is going to be more valuable and readily seeable, if you will, than that dollar avoided in the future.
You're at a company that's spitting off a lot of cash. It's an awesome place to be. There are a ton of companies out there, though, that have to make resource allocations for dollars in, but don't yet see the dollars out. How is your job more difficult? Or you could take it a different direction and say more fun. Sure. Because you have all these resources to reinvest back into the business and you have to make those capital allocation decisions on the way out.
I would just say it's different. I've done both. Before this job, I was the CFO of a publicly traded aluminum company. And while aluminum's having a moment, given what's going on in the macro environment, a lot of times this is an industry that, like a lot of commodities, will make money for 90 or 180 days and lose money for 3 years. Right. And that's just the way those businesses work. So I've been on either side. And what I would say is it's just different. When I think about capital allocation, the really important thing is when you generate cash, a couple of things. Number one, you don't want to have bad habits. OK, so as a finance leader, if you're trying to find enough money to pay the rent or make payroll, you're going to make sure you're on top of everything. Right. Even when you're generating cash, you have to bring in, I think, that same healthy level of paranoia. And I had to do that with this company. That was quite a bit of work. On the flip side, if you're in a company that you're really resource constrained, there's a quote I like a lot, is that there's always opportunity in a crisis, right? So if you're resource constrained, don't focus so much on making sure that, you have $10,000 extra to, not worry about next month lease. Always make sure you've got an eye on the horizon for something that may make sense to do where you could take on some debt and actually grow the company. It's really easy to fall into those traps on either side. But how I think about it here, coming in, that was probably the thing I had to get my head around the most. First of all, what is the right debt level to run with a company? This is another one of those magical finance things, is there's all kinds of formulas. None of them give you the answer. I'm sorry to tell you, if somebody's listening saying, what's the formula to know how much you should lever your company? There isn't one, right? There's a bunch of things and a bunch of questions that you ask. So once I got that to where I felt comfortable, then it comes to how do you deploy that cash? And this is another thing I think finance is really critical in, is you have to sometimes separate emotion with fact, right? Is it looks great to grow, But if you actually look at the risk weighting of that growth and the fact that it may not materialize, is it better to do something more near term? And that's where the finance team can really help. Now, again, you never want to focus only on the math. The math won't give you the answer. The math tells you what questions to ask. But when you have that cash available, should I buy back my shares? Should I pay down my debt? Should I go and buy that other company? Remember, we've already invested everything we need to do to run the company. That goes without saying. In that environment, you need to be able to bring that perspective to the board and to the CEO that says, hey, the math says this. Strategically, this may be a good idea. Let's have that debate now that we all have the same set of numbers in front of us.
You know, coming into my last CFO role, we were able to get to break even. Now, I haven't ever been in a position where it was just spouting off tons of cash and had to figure out what to do with it. So I'm sitting here now saying, you know, I feel a bit insecure in that capability that I haven't managed before. I'm curious if there was maybe a side of the balance sheet or a skill set that you felt that you had to learn when you stepped into your role.
Yeah, I don't think it was different from yours, CJ, right? Is if I look at my career, I was very lucky. I spent 15 years at General Electric, which was wonderful. 5 years at ITW before I did my first public CFO job at a company that was much smaller. So let me tell you what that felt like kind of day two, right? So going out is you go into a smaller environment. You don't have that support anymore. So there's one level there's no levels of authority between you and the outside world, which is extremely disconcerting.
It's a weird feeling.
It is disconcerting, but it's also liberating, right?
Yes, so at the same time.
You got to weigh those two things. And then the second thing is, I think more directly to your question is, you know, I grew up in companies that had issued all their stock, a lot of it in the 1800s. You know, the lower right-hand corner of the balance sheet had been set, you know, since the Great Depression. There wasn't much to do there. So I think coming out, there's naturally going to be an aversion to capital markets. Is probably number one. And here's another thing about capital markets. And by the way, what capital markets means is access to debt and equity, funding for the company. I define that because if I were listening to this 10 years ago, I would know the term and not really know what it meant. So, and I think that I'm going to pull on that thread for a second.
Sure.
When you're into those capital markets, one thing that becomes readily apparent is it is a whole subculture. There's a different language that's spoken there. But here's what I will promise you, the listener, right? As you go out to those capital markets, if you came from a academy company or a larger company and you're out on your own, typically your first CFO job is going to be, unless you get promoted internally, it's going to be a smaller place than where you came from. That's the way it works, right? Know that you're going to face a new language and know that no one's going to take the time to explain it to you. But also know that when you ask, you will be the 10,000th person that's asked them that question. So the example I use is when I was first out, we were going to do some debt. It was a little small thing, but you know, the lenders kept saying it was pari passu. I was like, well, that's good. Is that like an hors d'oeuvre or something?
Are we going to a French bakery? What's going on?
I Googled it and but that didn't help. I'm like, okay, I could define the term, but how do I place it in the context of this discussion? So I went through 2 or 3 discussions, honestly, pretending like I knew what it meant, and I didn't. And finally, I said, you know what? If this goes south, I'm going to have to find a new. So I asked. And after I asked, it was 2 minutes into it. There was 2 other terms I didn't get in the explanation. Once they explained it to me, it is so simple. It is, if you've made it to that level, anything in the capital markets you can understand, make people explain it to you. The other, I think, trap on this is when you're not comfortable with something, especially when you get that big job, doesn't need to be a CFO job. Maybe you got promoted to lead your team or whatever. You feel like you've lost the ability to ask the stupid question. False. Ask the question. Ask the question. And I'm telling you that it's almost like what I tell my kids, right? When you get into a college, whatever college that is, you have the mental ability to get a 4.0. It's all about effort, right? We already did that stratification for you. Same thing in your role. If you got promoted, you've got the smarts, you're good, right? Go ahead and ask the questions because there's no amount of work you can do on your own in the pace that those jobs move that you'll be able to make up for that. So you need a little bit of comfort to do that. And for me, CJ, it was capital markets.
That's a great tidbit there. And there were some times where I had imposter syndrome when we were doing a capital raise, or we were looking to sell, or we were just going through, maybe it was even like an employment issue. And I'm talking to either lawyers that we were paying or investment bankers that we were paying. I think the first few meetings, I was like, I need to make sure I look like I belong in this room and know everything. And then I woke up like a week later and said, no, wait, we're paying them to help us here. And part of their job is to honestly make you as the CFO and the CEO look good to the board. And once I got my head around that, I was like, it was like a constant stream of like, quote unquote, what I thought were dumb questions.
That's great. And I actually, as I was preparing to talk to you today, one of the things I wrote down is imposter syndrome. And that is a real thing. It is, you'll always feel it. I felt it even long before I became a CFO. But here's what's tough about imposter syndrome, I think. So I've been around now for 25 plus years. I've seen the cycles, at least for myself. Here's what's different. When you go out on LinkedIn or even any kind of social media, you see your peers and you see all the things they've done. And it's so easy to say, wow, they've got it all together. Man, what am I doing? It's like, or when you talk to somebody and a lot of times they'll throw around the terms like they know, like they designed it. Everybody's got it. Everybody's got it. Happens at the board level, happens at the CEO level. With the higher you go in any company and the closer you get to the people who write the checks, right? Whether that's the customer or an investor, the closer you get to that transaction, it's hard. That's all there is to it. It's hard. Mm-hmm. It's fun and it's great, but that imposter syndrome is a real thing. You will feel it. I'm going to tell you, go ahead and lean into it. You won't, because it's impossible. But at the end of the day, just take away that everyone else feels it too, no matter how cool and calm and collected they look on the surface. I promise you that.
There is something humanizing, though, about when you get closer to the person writing the check that you see just that. It's a person.
That's right. That is very, very true. And in any career, the ability to talk to people on a human level sometimes that's not possible. Like if here's the ultimate example, CJ, on an earnings call.
Yeah.
It is what it is. That is a formal, it's recorded, it's going to live in infamy, and it just kind of is what it is. But to the degree that you can do that and make just a little bit of a personal connection, you're right. They're people too.
Yeah. I want to transition to talk about mitigating risk, because part of the job, other than capital allocation, and I guess they go hand in hand, is also being the chief risk officer in a sense for the company.
That's right.
And I've actually heard that there's this slide, Craig, that you show people you work with that describes what mitigating risk looks like. I don't know if you actually have it with you or not, but I just want to get your take on this.
It's on my thing. Hang on, I'll get it. It's here all the time. Yeah. I've got it in plastic. Here it is.
Okay, there we go.
So before I show this, this is something I saw in it was a Six Sigma presentation at GE. It was probably in 1999. And I don't know why it just spoke to me. I'm like, well, that's a good way to think about that. And this is when I was 6 months out of college. And I don't know who did it. So if anybody watches this and this is your slide, I've been using it for a year. Reach out to me on LinkedIn. I'll buy you lunch. I don't know, but it's helped a lot of people. So hopefully that's why you decided. So here's how I think about it. So the way to think about it is you got pieces of cheese and you've got red arrows, which we call hazards on this slide, but they're risks. So think about cheese and arrows. That's what I want you to think about. So when I think about risk management, it's what are those? Well, first of all, what are the red arrows, right? What are the things that could go wrong? That's a really, really good exercise to go through with the leadership team. History usually gives you 2/3 of those. The other third, you can pretty much ferret out by talking to people who know how the business, how cyclical the business is and how the customers behave. So now you got those. The other things are building the pieces of cheese. So what are the proactive things that you can put in place, those known risks that are going to come at you, to make sure that by the time one gets through, it's only one and not five. I love that. And here's a real kind of tactical example. Think about in the accounts payable department, right? You've got a three-way match. You've got a telephonic contact. You've got a live customer list. All of those things are those pieces of cheese that say, if something gets through here, it's going to be enough of an exception that it'll get the right level of visibility and we'll be able to fix our process. That's how I think about risk management. And I think about that as when I'm in a review, I'm one of the pieces of cheese, right? Here's another thing on that. If you're in a review or if you're in a meeting, you've been invited to the meeting. This is really for the up and coming finance leaders. If you're in the room, if you got something to say it. If you're talking too much and here's my advice to you. Somebody says you're talking too much, be like, then uninvite me. Now don't speak just to hear your own voice, but if you've got something to say and you're in the room, you have the right to speak. And I want you to be thinking about this when you're in that room, right? Think about what is the financial view, what is the financial piece of cheese that you want to think about before that red arrow comes through. I've used that with accounting teams. I've used it with commercial teams. I just think it's a really good way to proactively think about how you manage risk. And let me say on the other side where I see this kind of fall off the wagon a little bit. Then it moves to crisis response, okay? Risk management and crisis response are different. When a red arrow gets through the cheese, risk management is over. You may want to go fix your process after. Now you're in crisis response. How do you handle that? You want to have a process. You want to have who's going to do what at this time. The reason I say those is because they are separate things. A lot of companies or teams or functions I've seen in the past mash those two things together. Don't do that. Do your risk management, run your risk management process. If something gets through, after you solve it, go solve it for the customer or the investor first, then come back and fix this process. But once something breaks through, and it will, now you're in crisis response, very different process. And make sure you treat them differently. That's my advice.
Craig, by the way, that was amazing. And that was the first visual we've ever had on the show. So there's a first for everything. We just put them on the moon. When you think about the hazards or the risks that are coming through, there are known risks and unknown risks. Are the types of the slices of cheese the same that you put there for known versus unknown, or how do you get your head around that?
Yeah, for an unknown risk, a lot of times what you're going to see is the slices of cheese are supposed to always be chipping away at the unknown portion, right? By looking at history, looking at the market, and talking to people who are closest to the industry and the customer. You should get that unknown risk down very, very small. When that unknown risk comes through, though, go right to crisis response, address it, then retroactively put it in your risk management process. Because the one thing you don't want to do, the other thing is I could build 1,000 slices of cheese. That'll slow down the company.
Yeah.
Right. So you have to know how many pieces to put in there. And that is something that is always a healthy tension, I think, between whether it's audit or controllership on the finance side and sometimes the commercial side, or sometimes you see it legal versus commercial. That's a healthy tension. But what you want to make sure is that you don't want to choke the business, but at the same time, you want to put in the right amount of proactive risk mitigation. And the only way to make sure you've got that balance correctly is to kind of bring everybody into the game.
And what makes a CFO role really hard too is that you have to underwrite some level of risk, or else you don't have a business. Like you can't make money if there isn't risk, but at the same time, you can't, like you said, slow down the business to the degree that, people are complaining about it, or they can't hit the goals that you set for them. So I had this CRO who's a friend of mine, and he was saying, we have these aggressive revenue goals. I think we could hit them. But whenever I go to the CFO for we need Gong to listen to the phone calls or something, I think this will help with productivity. I've completely stopped going to him altogether, because when I go, it's just layers of duct tape. So it's like, how do I give people the tools to succeed without slowing them down?
Yeah, I think an escape defect would solve that rubric real quick, right? And I had an experience early in my career that solved that for me really, really quickly.
Really?
Yeah, I'll walk you through it. I was the CFO of the business, and the business is no longer owned by GE. It's been gone for a long time, so I can speak freely about it. At the time, it was owned by GE.
Okay.
And, we had an issue where revenue recognized in advance, called deferred charge for my accountant friends out there, but is a revenue in advance of actually collecting the cash. By the time I walked into the seat, it was $1 billion. I'm like, how the heck is that possible? I mean, that just sounds like aggressive accounting to me. And after a year of work and a couple hundred auditors and a lot of hours, we ended up writing off $750 million, which even to big GE back in the day was very material. After you're out of, call it the fog of war, right? Then you step back and say, okay, now we're fairly stated. I can sleep at night. What happened? What the heck happened? What I saw was a misalignment of incentives. It's much more complicated than that, but like all things, if you boil it down to something simple, you'll Pareto get 80% of 80% of the answer. So misalignment of incentives. So what was happening was people who were incented in the short term also got to make the long term decisions. So they would get the short term benefit, but never have the long term pain. That was a big thing. So when I go back to thinking about how do you think about risk, one of the things, you think about how do you do edit checks? How do you do audits? No, that's so far down the stream. Don't worry about that. Come back and say, what are the incentives of your team? Make sure they align to the time frame that's relevant with the risk and reward of what they're looking at, right? And I learned that in a very hard way in 2009. And I had another experience here. This is one that I think is kind of fascinating. I was at the corporate treasury department of a large lender, and I was looking at how they funded their assets. And, so they're a lender. They sell commercial paper, and they also write 30-year mortgages. Well, in the concept of a yield curve, right, in normalized times, and we don't live in normalized times, my friend, but let's think about normalized times, right? Money that you borrow for a short amount of time, you have to pay very little interest on, whereas money that you borrow for a longer amount of time, like a mortgage, you pay more interest on. Well, as I was going through these books with the team I was on, we realized that there were 30-year mortgages that were funded with 30-day commercial paper. Again, misalignment of incentive. The person originating the mortgage and charging 6% was able to finance it with 30 basis points. So in that little 1 year nanosecond, this was in 2004, by the way, in that 1 year nanosecond, money fountain. What happened in 2008? What do you think happened in 2008, CJ? Right? So in that, when I think about those pieces of cheese, a lot of them, we talk about tactical ones in AP, but when you get into senior management, they tend to be more based on incentives and how you incentivize and measure people. And that's why you need a holistic focus on this. And the other thing I'll say on this is another one of the quotes. I love quotes. I don't know why. Another quote, and none of them are mine. I stole them from somebody, right? So the other one is leadership is 90% pattern recognition, right? That also has to do with risk management. So when you're talking about quantifying those unknowns, if you've been around for a while and you see something happening over here, sooner or later it's going to happen here. And if you're too young in your career to make that connection, make friends with people who have been there long enough to do it. You'll be smarter and the company will be better off for it.
Well, to that point, you said some of the pieces of cheese are based on history. And then you also said that risk management and crisis management are different. How do you ensure that there's a feedback loop, though, from the crisis management to go back into future risk management?
Yeah, that's great. I think you need to build that culturally into the company. In a lot of places, like here, what I really empowered my internal audit team to do that. I have a very good internal audit team. They're very strong. And they'll do that. Right. I think if that infrastructure doesn't exist as a senior finance leader, take it upon yourself to do that. Because here's the other thing is history is going to repeat itself. Right. What looks like a brand new problem today may have just a couple tweaks to something that happened 15 years ago. Right. So if that doesn't exist systemically in the organization, which I'm happy to say it does here, as the finance person, you are in a unique position to do it. Here's another thing about finance in corporate America. I think that's really true is regardless of the organization or the industry or the size of the company, finance people have the most information, bar none about the company. Now, if you're in a technical organization, then that's a product organization and that's a little different about the product, but about the company. In consolidation, how it fulfills its duties and how it finances itself and where the money comes and goes, no one has even 10% of the information that you do. So in a situation like that, where systemically crisis response doesn't come back in the risk management, you're uniquely positioned in finance to lead that.
I couldn't agree with you more there. I want to transition to talk a bit about soft skills.
Sure.
Why are hard skills, in your opinion, a commodity at this point for leaders?
Yeah, well, that's a great one. Here's how I think about that. In the early career, I see a lot of folks focusing on being the best modeler or the best accountant, and those
best basket weaver.
The best basket weaver. Yeah, great, thank you. Those things are really important. Like this is not to say don't focus on those hard skills, but I see it quite often at the expense of some of the skills, which is how do you work on a team? Is there an opportunity, regardless of how big or small, for you to be able to influence without authority? And I'll tell you why that's important. Being able to work on a team, allow people to take credit for the work that they did, help and coach and influence without authority. When you go around, now I've been around long enough that I've been in enough boardrooms and C-suites, and I've seen the big players, right? And I'm going to tell you, to a person, almost exclusively, that's their best skill, right? It's not, everybody can run a DCF. Everybody can go look at a market and say, here are the 3 attractive companies to buy. That feels really sexy when you're 3 years out of college, and that's important. Definitely do that, but use that time to learn how to work on a team, to learn how to make the people around you stronger, and quite frankly, to go find out where people are better at things than you are and ask them for help. That is what I see lacking in, call it the first 10 to 15 years. And you can really see it on the other end of the spectrum when you see, some of the global leaders, the thing that they do best. Here's another quote for you. The Maya Angelou quote. I think a lot of people know this one. You might not remember what somebody said, but you always remember how they made you feel. And we can all think of an example, whether it's a teacher or a leader or a parent or a friend, somebody who, I don't remember exactly what they said, but man, I felt great. Or you have a fond memory of that person, or a boss who was able to get more out of you without you feeling like you killed yourself to do it. Those skills are developed early on, right? And the people who can identify that and really nurture that skill set by the time they get to the C-suite tend to have really great organizational impact. So that's the investor side. But people also like working for them. So what I would say, and that's critical, right?
Yeah.
Is develop those skills in tandem with the hard skills. Because by the time you're 15 years in your career, being the best modeler is going to be a commodity. What's going to differentiate you, it's going to make people around you better, make you enjoy your role more, is can you lead a team? Can you work with the team? Can you identify where your opportunities are and somebody who's strong there and bring them in to help you and then reciprocate on the other side?
I didn't put 2 and 2 together that I had to start working on those soft skills even more so, probably until I was like 30. And I think it's because in school, we're so measured against like, what did you score on the test? And then you get to college, what did you score on the test? And then your first couple of years, it's like, how good of a financial modeler are you? That like your mind is just set to this like quantitative measurement, but like the soft skills don't really show up on paper. It doesn't hit you right in the face.
They don't. And that is an unfortunate reality, CJ. You're right on. And, another story I'll share is, I went to grad school later in my career, which was a great experience for me because 2/3 of the class I was in were doctors, lawyers, engineers, entrepreneurs, not finance people. And the one thing that I saw really quickly and right out of the gate was these folks were really hungry for the knowledge that you had, and they were super comfortable asking about it. Very senior, I mean, let's just say people had 10 times as much money as I did would call me on a Sunday and ask for my help. And I'm like, why don't people in corporate America do that? And I think because early in your career, you're so focused individually on your success. But if you're going to starting a company, or God forbid, you're starting a healthcare practice, you can't do it on your own. So you're more inclined to reach out for help. And I kind of really took that away, and that kind of solidified this message. And I look back and say, this isn't something I did very well. So we're clear, right? I see a lot of opportunity that I could have taken earlier in my career to do this. So I recommend if you're early in your career to do that. If you're later in your career, make sure your people do it. It'll pay dividends for them and all those around.
And I don't know if this is a skill necessarily, but like people underweight the value in just being likable.
That's right. I call it genuine. And it's likable and genuine. People will sniff you out, man. It's like if you say one thing and do another, forget it.
Authentic, I think, is the word. And I hate to use it because it's thrown around in so many like HR speak things now that like it's lost some of the gloss to it. But like it's really hard to not be yourself consistently, and people will sniff that out.
100%. I always talk about bringing your whole self to work, and I think that's important. The other side of this, sometimes it hits the ear of, well, that means you live at work and you got to work all the time. No, not at all. Not at all. A lot of these things work really well with balance. And, when you bring your whole self to work, and just like you said, CJ, I think you really nailed it, is you build trust. That's another thing. When you trust the people that you're working with and the people that are working around you, all of a sudden the fact that the email didn't get answered, that it doesn't matter anymore because the trust is there that it'll get answered when it needs to be answered. So bringing your whole self, being authentic builds trust. Trust builds a working environment that allows you to have a lot more balance than if you're in an environment that doesn't have that. And let me take that a step further. If you're looking at taking a new role, one thing that I tell people all the time, I followed this. This is one thing I did do, right? And it worked out well, is when you're looking at the new role, the first thing you're going to look at is, location, salary, what does it do for my career? All those things come in. I understand that. But I'm telling you, and I promise you, if you over-index on culture, that's always going to be your best pitch, right? If you work at a place that has the same values that you do, right? Then you're not, it's going to be really hard for you to have a bad experience if you're surrounded with people that have the same values that you do. You can sniff that out, right? So one thing I would say is if you're looking to make a change and all those other things come up on the top of the list where the kids can go to school, obviously, after that, you really think about the cultural fit. The job will solve itself if the culture is there, and a part of that culture shows up to you as trust. Really important.
That's amazing advice. Craig, you've worked at some really fascinating companies in stellar markets and then not so stellar markets. I'm wondering if you can maybe speak towards a time where you ran towards a tough market.
Yeah. I always say, always run to the tough market. I'd say, especially earlier in your career.
Yeah.
Let me explain to you why that is, and I'll give you an example.
It sounds scary, so you're gonna have to break this one down.
Yeah. Sure. So think about this. Let me go back to the grad school example, and I got a chance to interact with. I'm going to take a circuitous route, CJ, but I'll get there. Okay, I promise. So it's you've learned this thus far, right? Is when I was at grad school, I got to hang out with some of the kids who were doing grad school right after undergrad, so much younger folks. And when we would interact, they would all want to work at, this was 15 years ago, but still good companies. Everybody wanted to go to Apple. Everybody wanted to go to Meta. Everybody wanted to go to Google. I'm like, what are you doing? Go work at a paper mill. And let me explain why that is. And that's true, by the way. That's not embellished for screen purposes. Here's why. If you're a go-getter and you show up at a company that's struggling companies typically have less resources, so you get to do more stuff. And the expectations tend to be a little lower because the market's already in rough shape. That is high octane rocket fuel for a young leader. Rocket fuel, right? So if you show up, if you were to go to, Apple as a hotshot young MBA grad, you're going to be working around 30 of the smartest people, which is cool. That's great. But in a process that's so well designed, and if something goes wrong, there's 30 really smart people to pick it up. If you go work at the paper mill, that's 6 months from bankruptcy. Everything that you decide, you're going to know real quick whether you made the right decision or not. And that, especially early in the career, is a really good thing to do. It's a tough thing to do, though. So here's how I did it in my career. And I'd love to say I altruistically ran towards a tough market because I wanted to decide, but no, I kind of got there by accident and I realized it was valuable later. So let's be clear on that. But I moved from downtown Chicago to Erie, Pennsylvania. And this was a tough industrial business. It was just in a really, really nasty down cycle. And I found myself in front of the CEO of the company like on day 3. And I was like, really? And that CEO runs a Fortune 50 company today. And it's like, this would have never happened if I went to the place that was growing like a weed. You get to see and have your hands on so much more in a tough market. And it feels like in that nanosecond, well, am I leaving money on the table? If the company doesn't work out, is that going to be bad for me? It won't. Take that opportunity, especially earlier in your career, because again, the lack of a ton of resources and the lack of super high expectations is absolute rocket fuel as you're developing your style as a leader.
I'm a huge fan of what you just said. And all the friends that'll come to me and they're like, listen, I'm choosing between this company and that company. And one company is like very well known. It's like, I'm going to go to the equivalent of like OpenAI, or I'm going to go to this other company.
Right.
And I'm like, well, what do you want out of this job? And they go, well, you know, I do want to make money. I want equity upside in it. And then I also want an ability to own something and to shape and to build something. And I'm like, well, you can go to OpenAI and get, you know, all the pats in the back on LinkedIn, or you can go to this company that none of us have heard of. And that's where the opportunity is, because like there aren't 50 of you already there and it's not already established. So it's this counterintuitive thing. And sometimes you got to put your ego away, which is really hard.
It's really hard. It's really, really hard. But, you know, here's what I would say to someone watching and trying to contextualize that with their own career. Don't take my word for it. Go grab a bunch of folks that you consider to be successful that are, you know, let's say more than halfway through their career, and ask them. And I'm going to tell you, I promise you, within a standard normal distribution, you're going to find out that a high percentage of people will point to an experience like that in their formative years that really helped them where they are today. And it just happens to be the way the world works.
Yeah. Go to the paper mill.
That's right. Go to the paper mill.
All right, I got a quote for you.
Sure.
Life comes down to a series of a couple of interactions. This is one of them. What does that quote mean to you?
That is the infamous Bud Fox from Wall Street, 1987 version, my favorite movie of all time. And that means a lot to me. A, because it's my favorite movie of all time. B, because I really feel like that summed up the first 10 years of my career. So you're working at a huge company. You know, you work for 4 months and then you get that 90 seconds with senior vice president, and boy, you better nail it or your life's over. And that, you know, now in retrospect, I'm that senior vice president now. And believe me, I'm not, if it doesn't go well, it's not like I'm thinking about it at night when I go home, it's gone. Right. But it feels like that in the moment. And what I will tell you is those formative experiences, that's a great forcing function. That's a really, really, really good forcing function, because as you move up the ladder, so I'll take my role, for example. Anybody does my role, we do an investor day. Now that sounds like, you know, really nice. Ooh, wow, that's cool. Everybody comes and shakes hands. It's brutal. It's brutal. I mean, you're going out, you're making a 5-year commitment. You're going to spend all day answering questions, and it's fun, but at the same time, it takes a ton of work. It's really good to have the run up to that big event and really perform. So when I think about that quote, I think about earlier on, I thought that my life would end if it didn't go well, and it didn't go well a bunch of times, and I'm fine. But here's what I would say is take those seriously. Don't take them so seriously that you get nervous like I did, which probably was not helpful. But that forcing function early in your career, whatever incarnation it is in your career, take it really, really seriously, because that command performance is going to be really, really important the farther that you go up the chain. And I'll give you an example. Our CEO, you know, every 6 months or so, he'll be on CNBC with Jim Cramer. Imagine that. You know, walk into right off the exchange, and all of a sudden you're live on national TV and your mom's watching. She's watching. I mean, that's horrible. You don't want to do that. Your mom's watching, right? So think about that. That's going to come later. You can grab those formative experiences early in your career that'll get you as comfortable as possible later. So make sure you lean into those, because it's really important experience you'll draw off for a long time.
Well, I also think that it's a good thing if you're really hungry and putting pressure on yourself to make that 60 seconds or 90 seconds of FaceTime worth it, because it means you recognize that next time it turns into 2 minutes. Then after that, you get to do a presentation for 15 minutes.
Right.
Next thing you know, you're in 5 out of the 10 most important meetings at the company. So it's like, how do you double down and make that 1 minute something much larger?
I agree 100%. And the feeling of accomplishment when you do that, and you know, you're always going to be your own worst critic, but the feeling of accomplishment is great. And one other thing I say is, when you're nervous to do something like that, or even as you're going through your day and a new thing gets thrown at you, and now you own it, that nerves that you feel, if you're a brand new public CFO and you're getting on the phone with bankers and they're talking about what you don't know, and you're like, that feeling, let me tell you what that feeling is. That feeling is growth. Okay.
Yeah.
It manifests itself as nerves, but I'm telling you, that feeling is growth. And here's the unfortunate reality. It doesn't go away. You know, it's not like you get to a certain level, like, okay, I got it now. No.
Yeah.
But you'll learn how to deal with it. But that feeling, especially early in your career, remember that that's a healthy feeling, and that feeling is growth.
I had that feeling recently, but it was in a completely different context. So my 3-year-old, she's in daycare, and whenever it's your birthday, you can have your parent come in and read the class a book. So every night, me and her practice the book we were going to read. Okay, Craig? I come in that day. All the kids run up to you, give you a hug. You feel like you're at the top of the world. And I'm up there with Georgia, and I go, okay, do you have the book for us? She hands me a different book.
Oh, no.
And so, like, I've done fundraisers, I've helped sell companies, like I've been in high pressure situations. I've got 12 kids, 3 years old, can barely talk, looking at me. I got a new book. I'm like, did I forget how to read? Like, I had that feeling that that 1 year out of college CJ had in that moment.
That's great. And by the way, that was growth.
That was growth. Yeah.
That's funny.
All right, I'm going to take you into what we call our long ass lightning round. So the first question I ask every successful person on this podcast is, what's something you've screwed up on the job before?
Oh, long list. One thing that I think that raises to the top of my mind is making a bad hiring decision. And here's what I mean by that. Whenever you hire somebody, you never know if it's going to work out, but you can do your diligence and get as close as you can. When you're really busy and you're up against it, whatever, however that shows up for you, the tendency is to say, I just need someone. Anyone will be better than what I'm going through right now. Oh man, this is the devil's bargain. Don't do it. Right. So a couple times in my career, I was up against it, and it doesn't matter how big or small the pressures were. I had that feeling. Okay. And I made a decision without doing the full diligence. And in both instances, it was better for 60 days and then worse for 2.5 years. Right. So it's when you're in that situation, suffer through it till you find someone who's a good fit for the organization. Now, again, you can't always suss that out. But if something doesn't work out and you look in the rearview mirror and say, that was mostly my fault, don't put yourself in that situation. I've done it. I highly recommend you avoid it. That's a mistake I've made multiple times that I try to avoid in the future.
That resonates with me. And we were talking to David Lapter, the CFO of Dashline, five-time PE-backed CFO, and he was saying, I now in my career fight off the urge to get like a warm body just to cure today's problem. I'll wait 2.5 years if I have to get the right person in the role.
Perfect. And as I was giving the answer, I was trying not to use that term, but now that you did, that's the right one. It's like, I just need a warm body, right? It's so bad. It's so bad that I need to do that. And man, I'm glad to know I'm not alone on that.
No, you're not. You're not at all. All right, next one. If you could tell your younger self something, knowing what you know today, what would you tell him?
Move at your own pace.
What does that mean?
Move at your own pace. A lot of the people that I met, especially in the working world, are super high achievers. They just are. I was very lucky to work with them at a very young age. At the time, GE was just a magnet of talent. And you look around and it feels like everybody's doing better than you. Move at your own pace. And I think that, I kind of mentioned this earlier, CJ, but I think that's turbocharged with things like LinkedIn. And, you can look around and people are doing these, public CFO with market cap that's 10 times the size of yours. And, you're like, well,
it's just a highlight reel you're seeing.
A, it's just a highlight reel, and B, move at your own pace, because you will grow into your own personality and you'll find out what works for you and what doesn't. The constant comparison to other people is it's good when it's a little bit motivational, right? But it can become unhealthy really quickly, and that's something I fell victim to earlier in my career, and it takes some time.
It also takes some time to find your own voice in the workplace.
For sure it does. And those are things that you got to feel out. I'm a golfer, I'm a horrible golfer, but when you take a golf lesson, at least what I've been told is, I'll teach you how to do everything except putting, right? Because that's a very individualistic thing, right? And I think that on the career path, what you just said is the equivalent of putting, right? It's a very individualistic thing. But what I will say is don't relentlessly compare. It becomes unhealthy at a point. It stops being motivational and it starts just being noise. So don't do that.
More of a technical one. Can you walk me through your finance software stack? What tools does your team use to get the job done?
Yeah. Well, I can tell you, we are in the final throes of rolling out a new ERP, which is probably every CFO you've talked to's worst nightmare. It's a tough one, but I have got a great team that's going well, thank God. I'm putting in Oracle Fusion. Moving off of Great Plains, and I can't wait. I mean, this is the equivalent from stepping out of the early 80s into 2025. And I think where that's going to get us is probably more than we even anticipate. So I'm really excited about that one. And the other one that I've seen pop up in the business that I think does a nice job is Power BI. A couple of our businesses use that. And, the classic struggle with corporate finance is to be able to turn data into information, right? And like I said, finance has more data than anybody else. So what a lot of it is, A, do you understand it? And B, can you make it so somebody else understands it and it drives action? Another one of my favorite sayings, actually this one I did come up with, CJ. I told you I stole them all. This one's a Craig Conti original, is this is the way that finance puts income on the books. You tell operators and commercial folks a different way of thinking about it. You give them a piece of information that they didn't have. So when I think about the software stack, Power BI has shown me that some very, very good finance people can turn data into information, and information that is actually usable and causes the folks that are closer to the customer to make a different decision that's more profitable for both the customer and the company. That's real value.
I love that. Last one I got for you. What's the craziest thing in all your years of being a finance leader you've ever had someone try to expense?
Oh boy, how long you got? I had a... that's a really good question, man. I bet you've got some wacky answers.
We've got some bangers, yeah.
Oh, I bet you. So here's one that comes to mind. This was outside the United States. It was actually in Mexico City. And guy had, a lot of times outside the United States and bigger cities like that, the company for executive and above, you're provided with a car. Yeah. We don't do that as much in the U.S. anymore, but outside the U.S., still pretty standard. So the guy had a company-provided car, which is a normal, sedan, run-of-the-mill kind of thing. And he had submitted an invoice for the equivalent of like $2,500 US, and he had put in this obnoxious aftermarket stereo system. It was obnoxious. I was like, what? I went to him. I was an auditor. I mean, should have went through his manager. I don't know where his manager was asleep at the wheel here. So I'm like, what are you doing? Right? He's like, oh. I have a long drive on the way to perfect English, by the way. I have a long drive on the way to on the way to work in the morning. This allows me to play my music at a sufficient volume so I arrive refreshed and ready to start the day. I was like, points for creativity, but you're going to be cutting a check for that one, pal. So that's one that kind of stands out to me.
I hope he's using that car and playing this podcast right now.
I hope so.
Craig, this has been an absolute blast. Thank you so much for carving out time for us.
Yeah, this was great, CJ. I really appreciate it, and I'm happy to do it anytime. Thank you.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.